Tim, what do you say?
But we were warned, folks, about potential bowling metaphors and analogies and, anyway, puns. And so, anyways, we'll be careful. As much as I am concerned about China, Taiwan, that's not what the markets were worried about today. Markets were worried about a combination of three Fed presidents reiterating Powell's message from Friday. And how about this JOLTS data? So for people that don't know what the JOLTS data, it's basically job openings. And the rest of that acronym you can figure out. It doesn't really matter. The point is that there's so many more job openings than there are people to fill them. And as we have a payroll number on Friday and some CPI numbers across Europe and China over the next couple of days, that is where the market's anxiety is. It's rates that if you looked at a year ago, did you know that the 2-year rate was at 21 basis points? It's now at 346. A year later. So 2s, 10s, that spread we like to talk about to at least give you some indication of also where the economy is based upon the shape of the yield curve. It was 125 or so basis points a year ago. It's negative 36 and counting. So I think today was all about reiteration of interest rates moving higher. Equities don't like that. That's been digested all day. And as much as I think geopolitics have something to do with this and there's other reasons to be concerned, this is what we're concerned about.
And the JOLTS data really underscores the notion that inflationary pressures will remain, that wage pressures will remain for corporations. That is something that the Fed is going to have to even fight maybe harder to tamp down.
Yeah, so if you listen to most economists or strategists, they'll tell you that the stickiest parts of inflation are wage inflation. Again, I kind of think that will kind of correct itself as soon as we have the unemployment rate start moving higher. And that's the one thing, the one piece of the puzzle that really hasn't jived with a lot of this negative data that we've seen. If you think about the stock market, Mel, you just said that the S&P is down almost 8% in the last 10 trading days. We've had 4 moves of greater than 10% from a relative high in 2022, averaging about 13% lower. Okay, so here we are down about 7.5% or so from those recent highs. And if you think about all of those things that you say are weighing over the economy, well, they're clearly obviously weighing over the stock market here, too. And I would just say it's not done yet, even though that we've retraced 50% of the move off of the June low. I mean, I think if you think of the stock market as a market of stocks, well, the news for individual companies is about to get a lot worse. It's been incrementally bad all year. The stock market has been discounting that data as it's been careening lower. We had that rally when people thought the Fed was going to change their tune. That's not happening. There's really no reason why the S&P 500, if the economic data continues to get worse, which is going to cause the company level data, the earnings level to get worse, why the S&P shouldn't go back to those June lows.
We just heard tonight there's a report that Snap is about to lay off 20% of its workforce, so even more pain to come. And we continue to hear these drips and drabs about layoffs and job losses that haven't hit the numbers yet, or we haven't seemed to see them in the numbers yet, Courtney.
Yeah, and I think we've talked about this previously, but where a lot of the job losses are happening are some of your big tech companies, and those are some of the things that are selling off the most right now. And yes, those started to recover a lot when things were recovering the last 2 months, but we were saying that probably isn't going to last. You're seeing now those are starting to get repriced. I would continue to proceed with some caution there on some of your larger technology names. I do think those are going to be the ones that are feeling the pain as we're starting to see inflation is maybe not coming down as fast as people want. Those are the things that are going to be likely the most susceptible.
Guy? Tim pointed out how far we've come in terms of the 2-year yield in just, why are you laughing? 0.21%.
I missed you, Mel. I missed you.
I missed you all.
I mean, you've been gone.
From the bottom of my heart. I'm so glad to be back. But a lot has changed. I mean, especially in terms of the context for a potential, if you are a bull and you're hoping that there's going to be a big move higher in tech, or that is going to be the backbone of the market, the rate backdrop in and of itself is completely different this time around. So if you're hoping for some sort of a revival in some of the lower quality names, I don't know, that's going to be hard.
No, that's exactly right. And since you started with bowling, I'll just throw one more bowling metaphor out because why not, Melms? For the last, it coincides oddly enough. When I was a kid, there were no bowling guards in the gutters. In other words, if you were lousy, you were throwing it in the gutter because there was nothing to stop the ball. Then some genius came up with the idea, well, maybe we should democratize bowling and put these gutter guards up so everybody thinks they're remarkably Earl Anthony. Well, that's what the Fed did, too, for 15 years. But you know what? The gutter guards are down, Mel, and now everybody's seeing what a miserable bowler they are. And I'm actually being half serious. I mean, now exactly your backstop's not there. So I think you make a great point. 2-year yields are going to continue to go higher. I think there's a chance that the 10-year yield actually starts to go lower from here in a flight to quality. But I will say this, so it's not all doom and gloom on this Thursday. The HYG didn't get cratered today, and the VIX surprisingly closed unchanged. And, oh, by the way, today's low was basically a 50% retracement of the recent low in June and that high we made a few weeks ago north of 4,300.